Alrighty. So in today's video, I'm going to be sharing with you how I trade LEAPS, and this is a strategy that has made me six figures. So later on, I'm going over to my live trading account so you can actually see the position for yourself and how I actually put on this LEAPS. Now, if you're not familiar with what LEAPS are, I've already created a number of videos just to talk about that, but just a very quick summary. LEAPS is a long-term option trading vehicle, basically, where we want to put it on for some time, right? So the way that I trade it is more towards mid to long term. So before I get into the actual strategy, first of all, I want to get into how this LEAPS actually fit into our portfolio, right? So whenever we are trading options, or at least in my case, I like to see it as a well-rounded options portfolio. That means to say that I want my portfolio to have different option strategies, right? So some people, when they approach options, they might only trade one type of strategy. I don't do it that way, right? I like to put on different type of strategies, so this way, regardless where the market goes, I will always have some positions that actually capture it. And the key here is that they are all on different timelines, right? So the beauty about trading options is that you can actually choose the DTE that you want to put on the option strategy on, so they are not all on the same timeline. So it is possible that you have a bullish strategy, neutral strategy, and a bearish strategy on at the same time, and they all can be profitable at different times. Well, of course, they are not always going to be profitable in the sense whereby trade by trade is going to be 100% profitable, right? That is not possible. But rather, we want it in a sense whereby overall, each individual strategy can be profitable in the long term, but they are just going to profit at different times, right? Different stages. Again, they have their own timelines. So the way that I do it, as you can see, I have bullish strategies. So in case if the market goes up, I can still profit from, bullish option strategies. And if the market just stays somewhere in the middle, this is where you have your neutral strategies, right? These neutral strategies will profit from what's called the expected move. And then finally, if the market goes down, I want bearish strategies as well. So if the market goes down, hey, at least I have some option positions that can actually benefit from the market going down. So for this video, we're really going to be talking mainly about these bullish strategies down here, because that's where the LEAPS fit in. Now, some of you might be going, hey, is there any necessity or real need to actually trade this LEAPS? But the way when I talk about LEAPS, I'm talking about call LEAPS down here, where we participate in the long-term, upward movement of the overall market. So some people might be familiar with this strategy called the bull put spread. So the bull put spread is the put credit spread. Now, you can definitely put on these strategies, and I also do put on these strategies, but at the same time, I also want LEAPS. And the main reason is because when you put on put credit spread, what you notice is that you actually have limited upside, right? That means to say if the market keeps going up, and as you know, as of this recording at least, the market has kept continually going up. So if you have this put credit spread, what you'll find out is that, you miss out on quite a lot of the up move because your profits from selling this put credit spread is pretty much limited, right? And if the market keeps going up, then it's going to be a little bit difficult psychologically for many people to put on a put credit spread as it keeps going up, right? Usually you want to wait for a retracement or a reversal, but sometimes that doesn't happen, especially when the market is going up very strongly. So what is the solution here? That is to also have LEAPS in your portfolio. So that's where, for me, LEAPS come in, right? This is where it solves the mid to long-term positive deltas, whereby if the market keeps going up, hey, I am still in the market. And it is a very great way as a stock replacement strategy, because if you were to put into stocks, then stocks is going to quite, take up a little bit of your capital, and your return won't be as good, right? Because it's not really a leverage tool compared to LEAPS. Now, of course, if it's leverage, there's always a double-edged sword. You need to know how to use this leverage well. And that's what this strategy is also all about. So now let's get into the strategy for how I trade LEAPS. Now, my strategy is actually pretty simple, and it involves only 3 steps. So the very first step, and it's the one that is the most paramount to making this strategy work, because if you think about it, this is a bullish strategy. So stock selection is pretty important, right? Choosing the right underlying, if it doesn't go up in the long term, then no matter what kind of a strategy you put on in terms of options that is bullish, it's not going to make money. So when it comes to finding the right underlying, there are 2 ways, right? The first, you can go for fundamentally good stocks. So for me personally, what I think are fundamentally good stocks are Google, Microsoft, Meta, Amazon, so on and so forth. And these are the stocks that I personally have been trading and has been doing well for me. Now, that is not to say that you should do it as well. Again, you want to do your own due diligence. For me, the way I classify fundamentally good stocks, at least one of the important criteria is that it has increasing revenue and increasing profits, right? Increasing year on year revenue as well as profits. This way, you know that this company is doing well. Remember, every stock that we are choosing to trade, they are actually company, right? They are a company. That means to say their balance sheets, they're selling something. So naturally, if you want the stock to go up over the long term, at least most of the time, this company has to be doing well, because if the company is bankrupt or is always losing money, then the chances of it going up in the long term is not that high. So again, choosing fundamentally good stocks is paramount for this strategy. Now, if you're not very good at finding fundamentally good stocks, you can go the much more simpler way, and that is to find this positive drift index ETFs, right? I call this positive drift index ETFs because you want to find the broad-based ones whereby over the long term, it just want to go higher, right? It just wants to keep going up, right? Not all index ETFs are built the same. This is very important to understand. So for example, what are the positive drift index ETFs? Well, they are your most common ones like your SPY, QQQ, IWM, XLK, so on and so forth, right? There are quite a number of them. So there are quite a number of choices that you have. But as long as you stick to either of these two, do not go for those whereby it's a meme stock. These are stocks where, you know, likely are just meant for trading rather than doing it for the long term. So remember, for LEAPS, we want this more to mid to long term. If it goes up, you profit. So step number 2, this is where we get into the details of choosing the exact options, right? So basically, we're going to go for long-term ones. That's why it's called LEAPS. I look for the one that's above 365 DTE. Some people prefer shorter. Some people prefer much longer. Hey, this really comes down to you. But I'm going to explain to you a little bit why later on when we go inside the option chain, inside my trading platform. I'll explain to you why I want to go for a longer DTE, because it's actually going to benefit our strategy. And next, we want to also go for higher deltas, deep in the money options for this strategy. And again, let me explain this later on when we get to the option chain. And finally, step 3. So step 3, this is where you either choose to continue putting on the trade, right? If you want to continue, you roll it, because remember, options, they all have expiration date. If you come to the end of the DTE, you need to know what to do, right? Are you going to continue the trade, or are you just going to close it out and take, you know, whatever profit there is, right? So we want to do this roughly around 90 to around 180 DTE left. And the main reason is because of the extrinsic value. So extrinsic value, basically, it's what I call air, right? It's the air value of the options in a sense, because over time, once the DTE goes to 0, your extrinsic value also goes to 0. So that is why when we are placing our trade for the LEAPS strategy, we need to be very mindful of this EV. Okay, so let's head on over to my trading platform, and I'm going to show you more into detail how to execute this strategy. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Okay, so we are in my trading platform. This is my live trading account at Thinkorswim, as you can see over here. So you can see over here that I have a position on, which is Meta, right? Meta, to me at least, I think it's one of the more fundamentally sound, fundamentally strong stocks, which I have a LEAP option on. I actually have a few. I sold some of them away already as the market kept going up. So this one I just kept around, you know, just to see how much I can get. So as you can see down here, this is a LEAP option, and the profit on this so far open is about 33,000. So here is the good thing about LEAP. when it comes to comparing it versus stocks, and that is the cost, right? Because with stocks, you have to pay up the full amount, but whereas for LEAPS, you only have to pay, a part of it, a fraction of it, right? Because you have that leverage. Now, how much you actually want to pay for it really comes down to you and how aggressive. But I'm going to show you a guideline, roughly, where you want to choose this option. So why LEAPS are an important part of our options portfolio is because for the long term, as the market goes up, as you can see in this P&L graph down here, there is no cap, right? It can just keep going up and up and up. And as long as, the stock keeps going up over the long term, you can still keep profiting. So this leverage that you have can be quite good. So as you can see down here for Meta, my cost on this particular leap, as you can see, is only $4,000. And my P&L open as of now is $33,000. So it's pretty decent return. Now, the other underlying that I talked about earlier was the index ETFs, right? So another one that I like to put on is QQQ. So as you can see down here, this is QQQ, where I have 6 call leaps down here. And as you can see down here, the cost is about $66,000, but my P&L open is already $86,000, which is more than 100%. So generally, when you want to get this kind of return, it's a little bit harder with stocks, but with LEAPS, you can actually increase this return because of the leverage that you get, right? So I want to get into exactly how you're going to choose the right leap for this strategy. So what we're going to do is we want to go over to the option chain. So let me just go over to the option chain over here. So this option chain down here, you notice that there are many days. So as you know, for LEAPS, we want to go for long term. So this one, when I put it on, was much further out, right? I think it was roughly about 400 over odd days, almost 500 days. So pretty much similar to this one. So what we're looking at really is all this DTE down here, which is more than 365. As you can see, you can even go all the way to 1,029 days. That is if you want. But of course, one thing you need to know is that as you go further out, it's going to be much more expensive. Why? Because extrinsic value is equal to time, right? So basically, the more time you have, the more extrinsic value you have, which means to say you have to pay more for that position, right? So for this, let us just go to the 483 days one down here. So the one that we want to go for, I want to go all the way to roughly around 80 deltas, right? 80 deltas down here. So as you can see down here, we have a number of selection. Let's say if you go all the way from 80 to 90 deltas, you can find, this LEAPS option down here that is still going to be cheaper than if you were going to buy the stock outright, right? The stock right now, as you can see, is $438 for one stock. If you buy 100 stocks, that's going to cost you about $43,000 over dollars, right? So if you don't really have that much money, or you don't want to put too much in terms of cash into the shares, then LEAPS is going to be a very good choice for you, because as you can see down here, if we go to around 80 to 90 deltas, let's say, for example, if you go to the one at 80 deltas down here, 0.8, if you were to just click on the ask down here, you notice it's only $83, or rather $82 in terms of the mid price. So how much is this? It's actually only 8,000 plus. So if I was to click review, you notice that the cost of this is only $8,300 plus dollars. So you are controlling 100 shares for only $8,000 plus, when the cost should be around $43,000 odd dollars. So this is the kind of leverage that you can have. Now you might be wondering, hey Davis, what if I go further out in the money? Let's say, for example, down here, you can actually get it for much cheaper, right? So let's say, for example, if you choose this one down here, you can actually buy it for only $5,000. So $5,000, let me just show it to you. So you pay $5,000 to control a stock that is roughly worth $438. You have control 100 shares of that. So you have immense leverage, and it's pretty cheap for you to put on this strategy. But what is the issue with this down here? Now, the issue with this is that this is all extrinsic value. So you can see that there are 2 columns down here, right? The column on the left down here says intrinsic value, and the right side says extrinsic value. So remember, extrinsic value is basically the value of just time, which is basically air. You're paying a premium where the option does not have any intrinsic value. So as you can see down here, the intrinsic value is 0. So which means to say, if the market just stays still, does not move at all, you actually lose all this money, right? Let's say, for example, you hold all the way to expiration, 483 days later, it's at the same price, you're going to lose everything down here, right? So this is the very important key to understand when you're trading this LEAPS strategy. And that is that as much as possible, we want to buy the LEAPS that has less extrinsic value, because extrinsic value is going to go down over time. Remember, when it reaches 0 DTE, extrinsic value will go down to $0. So this is very important to understand, and that is why, as much as possible, I want to choose the option that has very little extrinsic value and more intrinsic value. So that is why we want to go all the way to roughly around 80 DTEs, right? 80 to even 90 DTEs. So you notice down here, once you go to the 90 DTE, now you're paying much lesser for this extrinsic value. So when you have a lesser extrinsic value that you're paying for, because remember, right now we are buying options, right? We are not selling premium, we are buying premium. So when you're selling premium, you want extrinsic value to be as high as possible, because you actually make from this decay of this extrinsic value. But when you're buying it, you want to buy it as little as possible, so that you have as little decay as possible. So how do you know how much decay is it actually having? This is where the theta column comes in, right? So let me just delete all these drawings first. So you can see over here, this is where the theta column is, and this tells you, you know, what is the theta decay roughly every day, right? As you can see, the lesser extrinsic value there is, the lesser decay there is. The more extrinsic value there is, then the more decay there is. So basically, you're actually pretty much fighting against time when you have more extrinsic value. So that is why our goal is to go for around 80 to 90 delta. So let me just bring back the column again, if I can find it, which is somewhere around here, right? So 80 to 90 should be somewhere around here. So one thing is that as your delta gets a little bit higher, the cost of these options actually becomes a little bit more expensive, right? As you can see down here, this costs roughly about 114 on the ask, whereas over here at the 80 deltas, it costs only $83. So it's a difference between 11,400 and 8,700. So this comes down to your own risk allocation, right? Your capital allocation. But generally, if you stick to around 80 to 90 deltas, you're good. Now, over time, as the market continues to go up, provided you choose the right underlying, of course, then here's what's going to happen, right? Your theta is actually going to start to go to 0. So as you can see down here, my position on this QQQ over here, this 6 LEAPS that I have reached a point whereby the delta has reached 100 on each of them, right? That means it's really deep in the money right now. So at this point of time, I'm essentially pretty much like I'm holding a stock position, but it's a leveraged one, because the cost that I put up for is much lesser than if you were to buy the stock outright. And at the same time, there is no theta decay, right? And my profits is now roughly about $1 movement is $1 profit, right? So delta also tells you how much you actually make per $1 move. So if your delta is 80 cents, right? 0.80, let's say, for example, we go to this one, it just means that every dollar move in the underlying, that means QQQ, let's say it goes from 438 to 439. If you own the stock, you'll be up $1. But because you're using options, this delta tells you that you have an 80 cents gain on this option. So for every $1 move in the underlying, you're getting a profit of 80 cents in the option, right? A gain of 80 cents, which is about $80, right? So how did my option actually reach 100 delta, right? 100 delta because I have 6, so it becomes 600 deltas. So how did it become 100 delta from 80? Well, basically, as the market goes up and up and up, this delta down here becomes higher and higher, because the strike price now slowly starts to become more and more deeper in the money. So that means to say, as the market goes up, you're going to start to make a little bit more each time, right? As it goes higher and higher, you start to make even more per dollar move, until finally you reach the point where it becomes 1:1. As you can see down here, here becomes pretty much 1:1 move. Now this works on the upside, it also works on the downside. But here's the cool thing on the downside, right? On the upside, as the market goes up, you start to make a little bit more each time as the market moves up per dollar move. But on the way down is the opposite, because as the market comes down, your delta starts to drop as well. So when your delta drops, it just means that as the market goes down, you start to lose lesser and lesser and lesser each time. And here's the cool thing. Although your intrinsic value starts to drop as the market starts to go down, your extrinsic value actually starts to go up. Can you see down here? You can see that the extrinsic value starts to increase as this delta starts to decrease. So what this means is that you actually have a very nice cushion when the market drops, right? When the market drops, if you're holding on to stocks, hey, you're going to lose, for every $1 drop, you're going to lose $1, right? For each share that you're holding. Now, for options, it's slightly different. So as it goes down, you no longer start to lose even more, but you're going to start to lose even less, and mainly also because extrinsic value starts to increase as the market drops. So this is step number 2. We want to choose roughly 80 to 90 deltas and go for the DTE that is more than a year. Now the final one is, what do you do once you have reached close to around 90 to 180 DTE? So I use that as a guideline for us to either roll or close, is because theta starts to decay rapidly as it gets closer and closer to the expiration date. Now, given that, let's say, for example, your positions still have quite a bit of extrinsic value, that means the market hasn't really gone up a lot just yet, then this position that you have, the value is going to start to erode pretty quickly towards the last 90 days, because that's when the theta decay really picks up. So at that point of time, this is where you need to decide whether you want to close out the trade or to roll further out in time. So I'm going to use this as an example down here. Now, there's still 329 days left, so I'm not really going to touch it just yet. But let's say, for example, it's going to be around 180 days or maybe 90 days left. This is where I want to start to roll it. So how do you roll it? You just have to click roll, and then this is where it's going to show you your options, right? So as you can see down here, when I roll this, what I'm doing is that I'm selling away this 329 down here, and then I'm buying the one at the further out date down here. So now the key thing down here is you want to always reposition it back to around the 80 to 90 deltas, because that's where we started it off. So if your position is going to be roughly at around 50 deltas at the point of time where you roll, then this is where you have to actually put up a little bit more capital to bring it back to 80 to 90 deltas. But if your position is already very deep in the money like mine over here, then when I change it to roughly 80-90 deltas, you're going to see that I'm actually going to get a profit, right? So let me just see what is the 80 to 90 deltas here on the 483. So let's say, for example, this is the 483. Let me just check. Yep, this is 483. So I am going to go to 80 deltas at 394.78. So down here, what I'm going to do is I'm going to sell my existing one, and I'm going to change this strike to around the 80 delta one, which is 394.78. So if I go to 394.78, now you will notice there is a minus 172, which means to say I'm getting a credit for rolling this. Why? If you think about it, rolling is pretty much just closing out your existing position and then putting on a new position. So rolling, in this case, what I'm doing is that I'm closing out my profits already, and then I am resuming the trade by buying the next leap at around 80 to 90 deltas, which costs much less. So as you can see down here, if I was to click review, you can see that immediately I'm going to get a credit of $103,000 to put on a new position. Alright, so this is my LEAPS strategy. As you can see, it is a very simple 3-step strategy, and it doesn't have to be complicated, right? A simple strategy just like this has already gotten me over 6 figures. So if it can give me this kind of results, it can for you as well. By the way, if you like this video, then you're absolutely going to love this next video which I have for you, so go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.